We're ready now for our next presentation titled The Cross-Section of Subjective Expectations, Understanding Prices and Anomalies. And this paper is by Sean Myers, Richard DeLao, and Xiao Han. And what they do is decompose the cross-sectional differences in the level of the price-earnings ratios using professional forecasts and find that subjective expectations have substantial potential to explain this cross-section. Sean Myers will present the paper. Sean is an assistant professor of finance at Wharton, whose research interests include asset pricing and macroeconomics, with a particular interest in subjective expectations. Prior to joining Wharton's faculty, Sean was a postdoctoral fellow at the NBER. His work has been published in the Journal of Finance, Review of Financial Studies, and Journal of Financial Economics, and he actually was previously awarded the Jacobs Levy Center Research Paper Prize for Best Paper in 2023. Sean's presentation will be followed by a discussion from Ray Iwanowski. He's the co-founder of SECOR Asset Management, a global asset management firm that provides advisory and portfolio solutions capabilities for institutional clients. Ray has served as Chief Investment Officer of SECOR's Quantitative Investment Platform. Prior to founding SECOR, Ray was Co-Chief Investment Officer of Quantitative Investment Strategies at Goldman Sachs. I'll now turn it over to Sean for his presentation.
So first off, thank you to the organizers for having this paper on the program. So this paper is going to center around one main question, which is simply what explains the differences we observe in valuation ratios. To give a recent example here, as of this month, both Tesla and GM have annualized earnings of around $5 billion, but we see that Tesla is trading at a price-earnings ratio of around 250, whereas GM is trading at around 9 times earnings. So we want to understand what can quantitatively justify this 25-fold difference. Now, to start this off, I want to just list a puzzling empirical fact from the data, which is simply that on average, high price-earnings ratio firms are followed by prices falling rather than by earnings rising. So this equation here is just showing everything in logs. It's just saying the simple statement that your price-earnings ratio needs to equal the change in your earnings minus the change in your price plus your future price-earnings ratio. And what this graph here is showing is a simple exercise where we take all the CRISP firms from 1952 to present. We just sort firms into 5 value versus growth quintiles. And then we just track the difference in buy and hold earnings growth and price growth between the top value quintile and the top growth quintile. And what we see here in green is that there is some difference in earnings growth between these two sets of firms. So growth firms do, on average, have higher earnings growth than value firms. But quantitatively, really the big difference is in this red line, where we see that growth firms just have substantially lower price growth than their peers. Now, I said this was a puzzling fact, so why is this puzzling? It's because there's really only 2 possible explanations for this. The first explanation is that markets know that there's this difference in price growth between these different firms, which would mean that differences in price-earnings ratios need to largely be explained by differences in risk exposure and discount rates. Essentially, firms are willing to tolerate much lower returns on these high PE firms, and that explains a large amount of the differences in price-earnings ratios. The other explanation is that markets don't know this, and they're surprised by the poor performance of these high PE firms on average, which still gives a puzzling result because it would say that most PE dispersion is due to mispricing. And in this paper, we're going to try to disentangle the two, but the big motivating fact is that it needs to be one of the two. Something needs to justify this large difference in price growth between the two sets. So in this paper, we're going to decompose differences in price-earnings ratios and split it into expected earnings growth and expected returns. So we'll do this using professional forecasts as well as just the realized future outcomes if you just buy and hold these firms and trace out what happens in the future. A key element of this paper is that we're not going to be very interested in short-term returns. What we really want to focus on is explaining the level of price-earnings ratios. So rather than explaining fluctuations in firms' prices, We just want to understand why they start off so different from each other, rather than where they're going to move over the next, say, 3 to 6 months. In general, we're going to study the evolution of the expectations and these price ratios after earnings are realized. And in the paper, we extend this to other anomalies beyond the value anomaly. But for the sake of the clock today, I'm just going to hold off on that section. And then in the last part of the paper, we propose a quantitative model to try to explain these empirical differences in price-earnings ratios, and we'll test the model's ability to match these decompositions, as well as the timing of these expectations and earnings realizations. To give a quick preview of the results, first, we find that errors in earnings expectations appear to account for a substantial amount of price-earnings ratio dispersion. So in terms of realized results, the first graph I showed you is basically this first sub-bullet, which is that differences in price-earnings ratios seem to largely be related to differences in future returns rather than differences in future earnings growth. When we look at real-time professional forecasts, we see something very different, where differences in price-earnings ratios are largely explained by the expected future earnings, and there's only a moderate role for expected returns. So we see a big disconnect between the realized outcomes and what people were anticipating. Now, a natural question is, if there are errors in these expectations, why aren't these errors quickly traded away by more informed arbitrageurs? And the explanation seems to largely be that these beliefs are fairly stubborn. After earnings disappointment, we don't see a large reversal or correction in these earnings expectations. Instead, disappointment is largely attributed to temporary shocks to earnings. And people maintain fairly optimistic earnings expectations for these high PE firms. What this means is that it's fairly hard to trade against this over short periods. You need to be willing to hold positions for multiple years in order for this mispricing to resolve. And that can help these stocks stay elevated or depressed in prices over long stretches of time. And then in the last piece, we find that a standard risk premium model, including these stubborn beliefs, performs fairly well in terms of matching these facts. So we find that by itself, the risk premium model really struggles to match both the realized decomposition results as well as the expected decomposition results. But if you take this otherwise standard model and incorporate these very stubborn expectations, now you can perform quite well at quantitatively matching these moments and explaining this dispersion that we see in price-earnings ratios. Okay, so with that said, I'll just jump through the 4 main pieces of the paper, which will be the data, these decomposition results, this evidence on stubborn beliefs, and then finally, I'll give an abbreviated version of the model. So for the data, it's going to be fairly standard. We're going to look at a sample from 1999 to 2020 from all of the major stock indices. We'll take realized earnings, prices, and returns from CRISP. And then importantly, we'll take these earnings growth expectations from Thomson Reuters IBES. So these will be professional analyst forecasts, which will cover the earnings forecast for 1, 2, 3, and 4 fiscal years, as well as long-term growth beyond that. We'll also have the price expectations, which will be taken both from Thomson Reuters as well as Value Line. So this will cover a 1-year and a 4-year forecast. In terms of sorting the firms and creating portfolios, what we do is simply that each month we take all the available stocks, we sort them into 5 value versus growth portfolios based on book-to-market ratios, although you get fairly similar results if you sort them by price-earnings ratios. And then we're just going to measure their expected and realized future outcomes. So at the time we sort firms into portfolios, we'll measure the expected earnings growth and price growth over the next 4 years. And then we're just going to track the buy and hold realized earnings growth and price growth over those next 4 years, importantly without any rebalancing. To give some context here on these analyst forecasts, we have a fairly large literature documenting that they're quite accurate at the firm level, but there can be biased expectations once you start to aggregate up to portfolios. So in terms of incentives, we know that both tenure and compensation is fairly tightly tied to the accuracy of these forecasts, and that they seem to proxy relatively well for investor expectations in the sense that after these forecasts are revised, we see prices move fairly quickly in the same direction as these expectations revisions. Probably the most compelling evidence that these are accurate forecasts has been comparisons of these forecasts with other methods for forecasting future earnings. So one of our colleagues, Jules van Binsbergen, has a paper showing that these analyst forecasts outperform normal linear statistical models of earnings. And even when you put this into a fairly complex machine learning algorithm, you still find a noticeable improvement if you include the analyst earnings forecasts into that algorithm versus when they're excluded. So they're incorporating information that can't just easily be teased out of the publicly available CRIS data. Additionally, beyond their earnings forecasts, there's also evidence that their price growth expectations predict realized price growth almost 1-to-1, which is a recent paper by Paul Decaire and John Graham. Now, despite the fact that they're fairly accurate at the firm level, what I'll be emphasizing today is that once you start aggregating these expectations into portfolios, you start to notice much more predictable errors. So while they're very good at distinguishing Apple versus Microsoft and who will do well over the next 2 to 4 years, you can tend to find waves of, say, over-optimism about the entire tech sector or about the entire market as a whole. Okay, so with that said, let me jump into these decompositions. So this decomposition is going to center around a present value relationship. If you're familiar with it, it's just a classic Campbell-Shiller decomposition. So this is going to start from a generalized version of that first equation I showed, where in logs, the price-earnings ratio needs to be related to the change in earnings minus the change in price plus your future price-earnings ratio. We're just going to work with a slightly approximated version of this, where you can use returns instead of price growth. So a nice thing for this identity is that because it just comes from the definition of returns, this holds under any probability distribution. So even if people aren't rational, this still holds under their expectations. So what you have here in this second equation is simply the statement that up to an approximation error, a firm's price-earnings ratio needs to be equal to its expected earnings growth minus its expected return plus its expected future price-earnings ratio, which is simply saying that if a firm has a high price-earnings ratio, it has to be that it's expected to have high earnings growth in the future, it has a low discount rate, or it's just expected to carry that high multiple forward into the future. Now, given that there's multiple pieces to this present value identity, a natural question is, how important is each part of this present value identity? So are differences between firms and price-earnings ratios mostly coming from the earnings growth expectations, the return expectations, or these future multiples? This is where we're going to use a variance decomposition. So this equation is just saying that the variance over I in price-earnings ratios has to be due to the covariance of price-earnings ratios with these three individual components. So the first piece is the covariance of the price-earnings ratio with expected earnings growth. The second piece is the covariance with negative future returns. And then the last piece is the covariance with future price-earnings ratios. All this is saying is just that differences in price-earnings ratios have to be explained by the high PE firms having higher expected earnings growth, the high PE firms having lower expected returns, or the high PE firms having higher expected future multiples. And that combined, this needs to explain the total cross-sectional variation in price-earnings ratios. Now, a nice thing about this decomposition is that it captures both magnitudes and timing. So what matters here is not just correlations, but how large the numbers are. If you have a huge difference in price-earnings ratios, you need a huge difference in expected earnings growth or a huge difference in expected returns. And that's what these two green and red terms are going to capture. Additionally, it lets you capture timing because you can do this decomposition for different horizons H. So you can see if the difference is coming from 1-year earnings growth, 2-year earnings growth, etc. From here forward, since I'll be showing a lot of graphs in different bars, anything that's in green, you can take that as shorthand for the high price earnings ratio firms having good growth. Anything in red, you can take as shorthand for bad returns. And we want to understand which of these two forces are more important for explaining the differences in price earnings ratios. So to start, what are the outcomes if you just plug in realized future earnings growth and realized future returns? That's what these graphs are showing here. So on the left, we're plotting this cash flow component, so the covariance of future earnings growth with the price earnings ratio in the green bars. And we do find a positive contribution. So the way to interpret these bars is they're saying that about 10% of differences in price earnings ratios are explained by 1, 2, 3, and 4-year future earnings growth. However, that 10% is really dwarfed by the other component, which is returns. So the right-hand side of this figure is showing a similar relationship. It's the covariance of price earnings ratios with negative realized returns. And here we're seeing that about 15 to 30% of variation in price earnings ratios is explained by the first 1, 2, 3, and 4 years of returns. So this is just a condensed version of the graph I showed you at the beginning, where we simply find that differences in price earnings ratios are somewhat explained by differences in future earnings growth, but really the lion's share is coming from differences in future returns. Now, how easy is this to explain? The short answer is it's quite difficult to explain. So a lot of our standard models that we have to explain risk premia and short-term returns really struggle to match this decomposition for the level of price earnings ratios. So in this table, in green, I'm showing the numbers that we get from the data, where at the 4-year horizon, we find that cash flow differences explain about 10% of differences in price earnings ratios. And if you push this out further to a 10, 15-year, or you can kind of calculate out to an infinite horizon, cash flows explain about 30% of the differences in price earnings ratios. Whereas in the far right column, what we see in the data is that 4-year returns account for about a third, so 32% of all price earnings ratio differences. And realized returns, if you push this out to a 10 or 15-year horizon, seem to account for about 70% of differences. How does that relate to what we get in standard models? Well, in standard models, we basically get the opposite prediction. So what we see in the different rows of the table is that most of these models predict that this cash flow component should be, say, 70 to 100% of the differences. And more importantly, in this far right column, it's saying that this discount rate component should really be a single-digit component, maybe 3 to 4% of the total variation. We're just orders of magnitude off of having it being 70% of the total variation. And in general, you can play with these models, crank up the risk sensitivity. What you'll find overall is that it's very difficult to have a model where 70% of the differences in price earnings ratios are simply due to risk premia or discount rates. So to connect it back, it's very hard to have a model where Tesla is trading at 250 times earnings almost exclusively because it's an incredible hedge or it has a very low discount rate. You just can't quantitatively get numbers that large. Now, if it's not risk premia or discount rates, then the alternative explanation is mispricing. So this naturally raises the question of what kinds of cash flows and returns were people expecting on these high and low PE firms. So here's where we bring in the professional forecast data. So this is the exact same decomposition, but instead of using realized earnings growth and returns, we simply plug in the real-time expectations of what 4-year earnings growth and returns would be. And now we find a much larger role for the earnings growth piece, shown in these green bars on the far left. So what these bars mean is that about 30 to 40% of differences in price earnings ratios are explained by differences in 1 to 4-year earnings growth. So they really think that earnings are going to grow to catch up to price, rather than price falling to catch up to earnings. In the right-hand side, we see a smaller but non-trivial role for returns. I just want to highlight that we just have data for the 1 and 4 year horizon, which is why 2 and 3 are blank. But we see that up to about 10% of the differences are explained by people genuinely predicting lower returns on the high PE stocks. If we plot both sets of results together, you can see the differences between the realized results and the real-time professional forecasts. An easy way to interpret this is you can just interpret the difference in these bars as predictable forecast errors. So what we see on the left is that these forecasters are consistently overestimating earnings growth for these high PE firms. You can take it the other side, which is that they're consistently underestimating the earnings growth for the low PE firms as well. And then in line with this idea that they're overstating the earnings growth, in the right-hand side, we see that they're understating the negative returns. So realized returns are worse than they expected, and realized earnings growth are consistently worse than they expected. Okay, last set of results before I talk a bit about the model. How can this all hang together? Why isn't this traded away? It seems to largely come down to the fact that these expectations are quite stubborn over time. And you can already see a hint of this just in the graph that I've been showing, which is that earnings growth disappointment occurs fairly quickly. So this is not something that takes years for people to see that they were wrong. Even within the first year, we see that realized earnings growth is substantially lower than what people were forecasting at that time. Yet in the right-hand side, we see that this large disappointment in earnings growth does not translate one for one into a large difference in returns. Why does this not translate? It's because people seem to expect earnings to bounce back after a disappointment. So rather than saying, I was incorrect about this firm, it's not going to grow very quickly, instead people say, I'm right that this firm is going to grow, it just didn't happen this year. There was some slip up, next year they're going to take off. They've hit a temporary hurdle. And because they still cling to those beliefs, we don't see a big immediate price adjustment. So to show this more formally, we look at regressions after an earnings surprise. So what this first graph shows here in the dotted line, this is a regression of how much you should have corrected your earnings expectations after an earnings surprise. So this is on average how much a firm's future earnings go up after an initial earnings surprise. And in green, what we have are the coefficients when you regress the actual revision in people's forecast on these earnings surprises. So the main thing is that after an earnings surprise, you really should, as shown by the dashed line, you should update all your expectations almost one for one with that earnings surprise for where you think earnings are going to go over the next 4 years. Instead, people essentially say, this was 1 year of good earnings, but it will be fairly temporary, and this will largely mean revert. It doesn't go all the way back towards zero. They do raise their earnings expectations for years 2, 3, and 4, but they only raise it about 10%, which is what this first column of numbers is showing. We can then see what happens the next year, because again, we're saying they didn't raise their expectations enough to meet this dashed line. Well, after the second year, they're still pleasantly surprised by earnings, and we see that they raise their expectations for years 3 and 4, again about 10%, here 12 and 9%. They're again, on average, positively surprised by the earnings. 3 years out, we again see this gradual increase, where then they raise their expectations for year 4. So they are updating their expectations, but it's much slower than what, say, rational expectations or a statistical model would imply. And in line with this fact, we see that returns adjust fairly slowly over time. So this is not just a feature of these professional forecasts. We can also look directly at these financial market returns, and we see that after these earnings surprises, we see multiple years of positive returns that are also about 10%, essentially in these low teens, in line with these 10 to 14% revisions in earnings expectations. Conceptually, this is quite similar to post-earnings announcement drift, but essentially at a much larger scale. We're saying that this is not just important for short-term returns after an announcement, But this is actually important for justifying these huge level differences in the prices, where one firm can just be 10 times the price of another firm. Okay. The last point I'll say here is that we find these stubborn beliefs are not just unique to differences in valuation ratios. We extend this result to 20 different anomalies and find fairly similar results. Okay, so in my last 7 minutes, let me talk quickly about the model. Since it's a quantitative conference, I'm going to mostly show the quantitative results. For anyone that's interested in the equations underlying the model, the slides are available on the website, and it is starting at slide 44. We have the full element. But I wanted to jump into basically what you get out of the model. Okay, so first, to take stock and essentially summarize what we want from the model. The first puzzle we want to address is the fact that common risk premium model really struggled to match the realized decomposition results, where we had a very low cash flow component, the green component, and we had a massive discount rate component. It was explaining 70% of differences in price earnings ratios. When we look at the real-time forecasts, they're actually a lot closer to what these models would imply, where people expect there to be a big earnings growth component. They expect growth firms to grow and live up to their name. And there's a moderate discount rate component. What this means is that price earnings ratio dispersion seems to be partly explained by differences in expected returns, but more largely explained by differences in earnings growth errors. So we'll have a model where we take a pretty standard risk premium model, where there's risk premium related to the timing of cash flows, and then we're going to add in these stubborn earnings growth expectations. Specifically, we'll have that each firm has an unknown constant earnings growth parameter that investors are trying to infer from realized earnings. So they're trying to figure out what is the underlying growth potential of this firm, and we'll use constant gain learning. The main outcome from this model is that these stubborn beliefs are going to be very important for the level of prices. One way to see this is that we consider an extended model where you can have multiple forms of biased expectations. So some of them very short-lived, where as soon as people see the data, they say, okay, I was wrong, and they correct. And other ones where they're very stubborn, where they say, no, this is just random luck, this is an offshoot, I think what my guess before, or whatever I guessed before, I'm going to stick with that belief. So I don't update very quickly. And we add some informed rational arbitrageurs to this model. And what you get is that in this model, only the stubborn errors survive to have a big impact on prices. And the intuition's fairly straightforward. It's simply that any of these short-lived biases get very quickly corrected by traders, because you just need to wait one period. People will see that they're wrong, they'll correct, and the price will adjust. But when people have very stubborn beliefs, this requires you to take the opposite position for potentially 4 to 10 years before this price is going to completely adjust. So for informed traders, they care about how quickly prices are going to adjust if they face any type of risk exposure limits, shorting costs, or liquidity costs. Now, in terms of the model, overall, it's summarized with just 6 parameters. But despite its simplicity, we find that it does generate realistic quantitative moments. So at the aggregate level, we're able to match the average price earnings ratio, volatility in the price earnings ratio, autocorrelation, and the volatility of returns. And then we also managed to match a number of cross-sectional moments as well as idiosyncratic moments. So you're getting realistic dispersion between firms where we see huge differences in price earnings ratios, and we see that these differences are very persistent over time. Okay, how does this model fit with the facts I showed you before? This is the same graph from earlier, but now it's included these black dots, which are the predictions of the model. So in line with what we see in the data, in the model, you have that high price earnings ratios are associated with much higher expected earnings growth, shown in the dark green bars, and slightly lower expected returns, shown in the dark red bars. On average, these high price earnings ratios are only followed by slightly higher earnings growth, shown in the semi-transparent, so the light green bars, and instead are followed by much lower realized returns, shown in the light red bars. Because of these fairly stubborn beliefs and this gradual learning process, agents learn their mistakes about earnings growth gradually over time. And so mistakes about earnings growth do not translate immediately into returns. Instead, you get this gradual accumulation in the light red bars over the next 4 years. Now, what are some of the implications of this model? One nice feature is that you can use this model to go beyond the 4-year horizon where our analyst professional forecasts end. The estimation from the model is that from people's expectations, they think about 2/3 of differences in price-earnings ratios will be explained by cash flow growth over the next infinite amount of horizons, but realistically something around 10 to 15 years. And about 1/3 will be explained by discount rate differences. The estimate for realized values is that cash flow differences will only explain about 15% of differences in price-earnings ratios, and discount rate differences will explain 84%. So another way to rephrase this is that the estimate is that of the dispersion in price-earnings ratios, about 1/6 is genuine differences in future earnings growth. About half is estimated to be errors in earnings expectations, and 1/3 is genuine differences in risk premia. Okay, since I'm now coming up on 30 minutes, let me just wrap up here. The main point I want to stress is that the level of price ratios is empirically quite puzzling. The fact that high price earnings ratios are not followed by large enough differences in earnings growth to justify those initial prices really leaves a large gap in our understanding of these price earnings ratios. We know these cross-sectional differences must be either mispricing or really large risk premia, say an order of magnitude larger than what we would normally predict. And while we have many quantitative models of the value premium as well as short-term returns in general, Gouffeau's presentation was about short-term returns. The subsequent presentation by Rob will also focus on these returns. We don't have as many quantitative models just for the level of price-earnings ratios and why firms have such dispersed levels for these valuation ratios. From the evidence we find, we argue that errors in earnings growth expectations seem to account for a large amount of these price-earnings ratio differences. Why do these persist and they aren't corrected? It seems to be because they're largely quite stubborn, and it's very risky and requires long investment horizons to trade against them. And to make quantitative progress on this, we find that a traditional risk premium model that incorporates these stubborn earnings expectations provides a fairly parsimonious explanation for what we find in the data. And other than that, I'm looking forward to Ray's presentation.
All right, well, first, again, I'd like the other speakers, I'd like to thank Chris, Bruce, and Ken for inviting me to speak here. It was an honor for a number of years to be on the advisory board of this great center, and even more of an honor to be asked to be a discussant on the paper. So thank you very much. And I'd like to start by saying I think it's a really nice paper, Sean and his co-authors. There's a lot of great content here, and Sean did a great summary of a great job of describing the model and the results. So a lot of what I had planned to speak on is going to be a bit of an overlap of what Sean said. I'm going to summarize sort of my read on the paper, and I think that might add some value in sort of digesting his very extensive results. And then after my quick update, there's one finding in the paper that I really want to spend some time on, in addition to a few suggestions or quibbles on how things had evolved. So, to start, this is what Sean said at the end. I think it's a very simple idea. Why do certain stocks trade at a higher PE than others? Why do some stocks trade at 50, others trade at 10? And, from the standard asset pricing equation, as Sean mentioned, it has to be explained by differences in either expected cash flows in expectations or expected returns and discount rate. And there's been a lot of research, as Sean had mentioned, about short-term expected returns, including some of the papers here. And the paper provided some references in the academic literature, and one practitioner reference that I'll come back to. There's an a shameless plug for, there's a series of papers written by a friend of mine at AQR, Ann Thielman, and his co-authors, and they address this issue as well. How do subjective expectations affect expected returns? But this paper is one of the few to focus on the drivers of prices. And there was a fun quote in one of the footnotes of the paper from one of my professors, John Cochran, in his famous 2011 AFA presidential address that said, in typical John style, "When did our field stop being asset pricing and become asset expected returning?" Now, expected returns, as we all know, are linked to price dynamics, but it's still incrementally interesting to consider what are like some of the key components of pricing. So I think the authors do the industry a service with that. And as Sean mentioned, the paper starts with an empirical exercise. And the empirical exercise is simply, let's kind of specify expectations, subjective expectations, using earnings growth and returns from professional investors or professional forecasters, and then decompose the cross-sectional differences in the levels of PEs across stocks, or in this case, portfolios. Basically, the econometric structure, Sean showed some equations, and this is like sort of my attempt to do a qualitative specification of these equations in a standard, using a standard Campbell-Schiller decomposition where you log linearize the return equation. You could derive, and the variables in this equation are demeaned. So Sean didn't really emphasize that, but it's basically looking at the excess PEs over some average, and that's on the left-hand side. And then they have to, as the equation showed, that roughly, qualitatively speaking, the sum of expected earnings growth up to some time, H, minus the sum of one period expected returns up to that time, H, and then the expected future PE at that time. So the interpretation is that higher than average PE must be explained by higher than average expected earnings growth, lower than average expected returns, or a higher than average expected PE. And then through some algebra that was quickly shown, you can then have a variance decomposition of these three important components. So the data, it was very clear on the on Sean's presentation. They use IBIS analyst forecasts out to 4 years. 1 year return forecast, use IBIS for the first year, and then use some value line long-term targets for 3 to 5 years, which are standard data sources in both academia and in the industry. Their series is from 1999 to 2020, and they provide some robustness testing going back to 1982. And then the decompositions performed on portfolios rather than individual stocks. All you guys are familiar with how individual stocks create noise. And also, in this case, when we're studying earnings, negative earnings are trickier, problematic in these kinds of contexts. So the portfolio sorts solve that. And so the decomposition results, just to restate, for using the 4-year horizon of forecasts, they obtain that earnings growth contributed about 43% explained 43% of the cross-sectional dispersion in PEs, negative returns 13%, and future PEs 39%. And in the paper, there was some conversation around fully informational rational expectations, or FIRE. And so there's some models that had been discussed that sort of have a rational expectations sort of structure. Now realize if you're going to try to do this decomposition, you could, because of the fact that forecast errors under FIRE models are uncorrelated with time t variables, you could just use realized returns, realized earnings growth, and realized future PEs to estimate that. So it seems like the authors brought these estimates in as a benchmark. So how will these forecasts and expectations, subjective expectations, compare to those when you use realized returns in the future? And you can see that the earnings growth component is much lower. 10%, and then the negative expected return, the negative realized returns actually contribute 32% of the variance, and future PEs 55%. So definitely off from the results that Sean and his co-authors found in expectations. So just to, again, just to re-emphasize, large percentage of dispersion in expectations due to expected growth of earnings. And in using subjective expectations, 13% of the dispersion of PEs to negative relative expected returns for higher PE stocks. So I kind of want to put a pin on that right now. We're going to come back to it. It's not clear to me why, that there should be this, still some lower expected returns to high growth stocks after cash flows have been accounted for in expectations. So when I was reading that, it was like a little bit of a puzzle in my mind, and I'm going to come back to it because I think, I'm not sure the paper, answers that, that well. And then, of course, in realized returns, the growth of earnings is much smaller, as Sean's graphs had pointed out. And so earnings do grow in the direction of the expected earnings growth, but not that much. And then the negative returns are bigger than expected. And one of the interesting things that was pointed out in the paper is you basically, what this is you're picking up a value premium in the returns. And it hasn't been the greatest period for value. So 1999 to 2020, those of us who traded value know wasn't great. And one little technical point that the authors make is, say it's not great. A lot of us do like sort of portfolio sorts, and we go long high value and short low value. And we found in that decade, the last decade or so, that wasn't very good. But in reality, their models pick up some, value premium in the cross-sectional dispersion using the broader cross-section. So I thought that was kind of interesting. And then, as the authors had said, if you look at these FIRE models, they don't really do a good job of explaining the results. One cool aspect of this paper that Sean mentioned is they then can also model this stubbornness in expectations. So a couple just points that have already been made. One thing was not clear, maybe not clear looking at the graph. The earnings growth surprises do persist. So he had that dotted black line. You saw that, there's a spike, and then generally in future earnings, that spike is realized. So you should, as you said, you should update your expectations, but the analysts only slightly revised on the shock. And actually, that then implies that earnings in subsequent periods, earnings growth are lower because they're like going down toward the initial forecast. And they only gradually react to this surprise. So that's something that many of us who are practitioners know as post-earnings announcement drift. And the previous models didn't capture this well. And of course, as Sean emphasized well for all of us, there is a limit to arbitrage, because this adjustment to the true forecast, so the better forecast, takes a long time. So you have to carry these positions for a long time, and it's not easy to arbitrage. And the other thing that they found was that the stubbornness works in anomaly portfolios too. So that was just another sort of robustness test, and a lot of us are interested in anomaly portfolios. So that held. And then I thought it was cool. They, went from just the empirical results to actually try to build a model to explain them. There's a cool quote from some recent survey paper that said, those of us who are doing quantitative or those of you guys, I should say, rather than just rejecting rational expectations all the time, it'd be helpful to build a model to explain the results. And that's what these authors did. Some of the highlights, there's a lot of math in the model. I went through, fairly carefully. It takes a while to understand it, but there's basically defined cash flow dynamics where there's an aggregate and firm-specific component, which includes trend and noise. Given an earnings surprise, the pricing agents update their expectations using the constant gain learning. And there's a parameter that specifies the percentage of the earnings surprise that is incorporated into the next period's earnings forecast, and what percentage is attributed to noise. So if that beta is small, that means that they don't really incorporate it that much. And there's also an interplay between these reactions to surprises and the risk premium, meaning it brings the risk premium down. And that's sort of how they help explain the results. One thing that is nice and interesting to some degree on this paper is they parameterized the model. If you recall, there was like 6 parameters or so, and it was all using historical data, except for the one parameter with respect to the beta. And they took that from a previous paper. The authors were Nagel and I forget the other, I don't have the co-op, Malamender or something like that, 2016 paper. And that was a paper on, learning about inflation. And so we'll come back to that later. But the main reason they gave to do it this way is to not cherry pick the results and find the beta that actually fits the results well. And then as you saw, the model explained the results really, really well. So I'm going to focus on some stuff that I just talked about for a second, but just to summarize, because this is the end of my summary of the paper, really nice paper, and I don't really have any serious critiques or even that much to quibble about on the empirical testing or the model specification. Couple of like minor points though, like one, there's the classic critique of survey-based studies that said, are the IBIS forecasts really representative of what's being priced? And some potential evidence that like Sean had said, yeah, they've done well, and there's all these studies, but some evidence that it might not be quite representative is sometimes on earnings day, there's like a consensus beat, and then you see the stock prices go down. So it's always curious to me why they beat earnings so well and the stock prices go. Now there's other things like, guidance and all that, but it could be that priced into the actual earnings expectations are expectations that are outside of the consensus analyst forecasts. And one like sort of intuitive reason why that might be the case is more and more of the marginal pricers these days are hedge funds and trading platforms, and they have their own analysts that might not be captured by IBIS. With that said, I don't think that's you could say that about any survey-based paper, and I think it's really appropriate that these guys use the data they use, and I think the results are good, irrespective of that small critique. I have one minor technical point on the model. I'm not going to, in the interest of time, I'm going to not talk about it. I'll talk to you about it offline. It doesn't really do much. The one thing I will say though, as a potential critique is, I praise the decision to use a beta from a previous paper to avoid cherry picking. The one thing about, so that's Malmendier and Nagel's paper. The one thing about it is the calibrated beta is 0.018. And so if I'm understanding correctly how these constant gain learning parameter is, that's saying only 1.8% of the surprise is incorporated into the next earnings forecast, and the rest, the other 98%, is considered noise. And that intuitively just strikes me as extremely low. And but you did get good results from it. And now also that paper is on inflation expectations. So it's possible that the mechanism of learning that goes into stock price forecasting is not the same one that goes into inflation expectations. So that would be my one quibble on the modeling. But here's my, for the rest of the time I have, which I'm losing time, that I really want to emphasize as an issue is going back to this 13% of the dispersion of PEs are attributed to negative expected returns. So even after reading this paper carefully, seeing your results, it's really hard to see the intuition of why investors would perceive the higher PE stocks to be less risky than the low PE stocks and would accept the lower expected returns. So why not, okay, we're having these errors in forecasts, and that's explaining the value premium. But outside of those errors, why would we still want lower, why would we still require a lower expected return on higher PE stocks? What's the relevant risks that are being priced such that the investor demands higher expected returns once the expected return in differential cash flow is accounted for? And there's a few quotes from the paper that I have up here. I have it kind of small, so you might be able to see it. And one of the things is the paper kept referring to Littau and Wachter's 2007 paper and actually how it was constructing its model and then some of the results that they were comparing to. So I'm going to come back to that. But basically, from these three quotes, if you really spend time on it, it's saying that investors prefer backloaded cash flows rather than front-loaded cash flows. And that those are perceived. So the reality is the value stocks actually have lower volatility than the growth stocks. So it can't be like a risk premium story with respect to volatility. So you have to say there's something about this volatility that the market doesn't care about and therefore doesn't give you a risk premium for related to the discount rate sensitivity. And so, to me, that was pretty curious. And it's kind of funny. Sean and I didn't talk beforehand. And I wanted to construct, to solidify this critique, I wanted to talk about a particular, anecdote or example. And I chose Tesla versus GM, right? So either great minds think alike, or that's just one of the most striking anomalies we see. But there's, just like Sean said, the PE of Tesla is 225 and GM is 9 currently. And presumably, when I have my own intuition behind this, I think Tesla gets this high premium because the market just thinks there's these fantastic innovations that are going on in Tesla now that will produce extraordinarily great cash flows 5, 10, 20 years down the road, and therefore could command such a high PE. And GM is kind of has their boring earnings and maybe their style of car making is going to, go out of vogue or whatever. And it's possible that that will prove to be appropriate, that Tesla will actually come in with these expectations. But of course, the paper shows that on average across portfolios, that doesn't happen. So one might still argue that Tesla's overpriced. But what does not seem intuitive to me at all is why Tesla is, considered less risky because its cash flows are backloaded. So I was searching as I was reading the paper for an answer, and I decided to go back to one paper that had been referred to a lot, which is the Littau-Wachter paper, where they actually discussed this concept of longer horizon equity is less risky, and it helps explain the value premium. So there's some of these bullet points are things that I took from that paper that wasn't clear from Sean's paper. Basically, the model assumes a time-varying risk premium, and then there's a shock to aggregate dividends called that cash flow risk, and the investors really price that, but then they demand a premium for bearing that risk, but then shocks to the discount rate are not really valued because they're assumed to be uncorrelated with the fundamentals and therefore not priced. And value stocks are more sensitive to the front-loaded need a risk premium to buy value stocks, but those farther in the future cash flows, we don't have to compensate for. And one of the things I was thinking about with this is, first of all, I'm not sure if empirically that's true, that the discount rate is independent of the fundamental cash flows. That paper, that Wachter-Littau paper, was written in 2007, and there's been a lot of data since then. But some people, practitioners, including a lot of people from AQR, Cliff Asness, Toby Moskowitz, have done some work disputing the interest rate sensitivity of growth stock, value stocks and growth stocks. And so I didn't read every single paper to see whether this is appropriate, but I think I find it dubious that that's true, or at least potentially. But one feature that wasn't discussed in either of those papers is these cash flow forecasts in the future. So you think Elon Musk and its team are so great, such visionaries, that they have these moonshots that are going to just, create all this cash flow in the future. When you think about it, there's got to be big standard errors around that forecast. Whereas the boring GM forecasts, what their car production is going to be for the next 2 or 3 years, you would think the standard errors would be much tighter. So in a risk premium kind of context, I don't know why you wouldn't require a bigger risk premium on the Tesla cash flows in the future. And again, shameless plug. So that's my one thing I want to raise to this group and to Sean about. It still doesn't make sense that there's a big negative expected return on value stocks. a relative expected return. Just to wrap up, my friend Antti Ullman and his co-authors have just written an 8-part series on understanding return expectations. So if you find this work interesting on subjective expectations, I encourage people to read this at least some of this series. As usual, Antti writes long stuff. Parts 4 and 7 are the most relevant on subjective expectations. And one caveat is the focus is more on asset class expectations rather than the cross-section of stocks. But a lot of Antti's conclusions or points, I think, do hold. And there's actually an interesting discussion around survey data in that paper, in those papers as well. What Antti emphasizes is certain cohorts of investors have different over or under confidences of survey data. So it's like stock pricers had these kinds of errors, but bond pricers are actually more pessimistic. And it's things that I think if you like this kind of work, you'd find interesting. And just the last thing, it always should be thinking if you're discussing on future possible work. I think it would be fun or neat to look at other types of portfolios under this decomposition. So with things that come to mind are meme stocks. Of course, you have the problem with negative expected return or negative earnings on meme stocks, but or like if you look at deep value or some sectors, might be fun to see those results given you have the machinery. And then one other thing would be, again, playing on like what can we practitioners benefit from this? You document stubborn expectations. It might be interesting to see, is there certain types of stocks? Is there certain states of the world? Is there certain sectors or whatever where the expectations are less stubborn so that we can exploit the post-earnings announcement drift more? And then obviously, I always think we should find an alpha strategy. And, maybe there's a world where if you applied Sean and his co-author's methodology, you could identify conditionally really big negative expected returns, but it has to be kind of conditionally coupled with the expectations will be less stubborn once there's news that says it's not as good. Because otherwise, like you said, you're stuck staying in a position for multiple years and financing the short and being susceptible to short squeezes and all that kind of stuff. So with that, I'm done. I went over my time. But really nice paper. I enjoyed reading it, and I was really happy to be able to spend some time on it.
Sean, if you can please join Ray on the stage, you can just briefly respond to his discussion if you'd like, and then we'll take some questions.
Perfect. Okay, so first off, thank you for the discussion. And in particular to the point about the value premium. So I'm very sympathetic to the idea that a lot of these explanations put forward are somewhat opposite of what your normal intuition would be. So I'd agree that kind of the first intuition would be that a firm like Tesla just has a lot more variance and risk associated with it. Now, so not to take away from previous authors, so kind of they put forward these explanations. Part of the thrust of this paper was to say, even if you take those explanations as given, they're just not big enough. So I'd be even more in line with the idea of if you don't even buy that explanation, kind of just push it all the way to zero, then it has to be errors in the earnings expectations. Part of this paper was to say, even if you take those explanations, they just fall quantitatively far short of what you need, that they only get you up to 13%. We're still missing the other 87%. So even if you kind of take those existing explanations for the value premium, the data is just requiring much larger dispersion in PE ratios than what they could generate. But yeah, I'm very sympathetic to that idea that it's very hard to get them big enough, and it's even questionable why they would go in that direction, which then opens you up to the only thing left then is mispricing.
Right. I mean, it's possible, like if the expected return wasn't a factor, then all the differences are in the mispricing, right? But if it's a factor, it's also possible that it's just for some reason people have a utility of buying cool stocks and disutility in buying boring stocks, which again is a behavioral explanation, not a rational expectations or a rational risk premium argument, right?
Yeah, no, that's totally fair. So I'd take our results then maybe as kind of a lower bound where we're saying we estimate at least 43% seems to be coming from this error, and at most 13% seems to be coming from a rational discount rate driven story. But I could see a case that it potentially all needs to be coming from some kind of overly optimistic expectations or just the desire to buy these stocks despite the historical underperformance.
Thanks very much. We had time for a few questions from the audience. Please raise your hand if you'd like to ask a question, but wait for the microphone to arrive.
Thank you, Sean. Pranay Gupta. IPES data has one unique aspect that the analysts which revise their estimates towards the mean are just catching up, and actually the analysts which revise away from the mean are more significant in determining price action. If you were only to take the expectations of the analysts revising away from the mean, I'm wondering if the percentage of the price action will be more significant from the earnings component.
That's interesting. Okay, so we haven't done the explicit exercise of looking at revisions away from the mean. We have split between large revisions and small revisions to see if there are some that are updating much more substantially than others. And we do find differences in the updating, but we don't find that they tend to move closer to the rational forecast, which would basically be that you should expect fairly similar earnings growth between these different firms. Basically, another way to say it is their updates are somewhat uncorrelated with whether it's a high PE firm or a low PE firm. But that's a good question about looking solely at the analysts that are moving the furthest away from the mean. If they are closer to the statistical or the rational forecast, then it still raises the question of what's justifying the price difference. If they kind of truly know that there aren't going to be these big earnings growth differences between the high and low PE firms. But it's an interesting question. It could be kind of to the earlier point that maybe we've understated the amount of over-optimism and that these analysts are pushing things even further so that you can get from that 43 up to closer to something to 100% coming from these overly optimistic or pessimistic forecasts.
My question is, did you try to introduce something like quality of the company leadership into your analysis? Because
No.
my guess that it's quite a substantial factor.
That's interesting. So no, almost intentionally, the exercise is kept very simple because, again, the point is that the only reason you would care about quality is if it somehow shows up in the future cash flows or shows up in the future returns. So it would still say that even if quality was your explanation, somehow we would need that quality is largely causing high and low PE firms to have similar earnings, but the high PE firms just to have much lower price growth. That's kind of the fundamental fact we're trying to get into, which would be that if we see large differences between high quality and low quality firms, why would that not be translating into their future cash flows? If that makes sense. So we want to kind of keep it distinct from, say, splitting value from other types of return predictors and just look purely at the valuation ratios. But it is, in terms of kind of talking about extensions, there's nothing that stops us from doing that. So kind of we did just the distinction of returns and earnings for this exercise, but there's nothing that stops us from in the future doing a finer separation where we also look at quality assessments across these different firms.
You say cash flows, it's like the same like earnings, but earnings consist of revenue and expenditures, right? So did you distinguish between these two sources of future earnings or realized earnings? Because it could be capital expenditures, it could be share of the market, it could be completely different causes of earning deceleration.
That's true, but again, somewhat similar to the earlier question, we ultimately care about what is the total profit the firm is earning. So for example, if you tell me this firm has a really high PE ratio because it has massive revenue, but its earnings are similar to other firms because it also has massive expenditures, I still come back to the question of, okay, then why is it so valuable? I mean, I don't price it off of the revenue. I don't receive the revenue. I receive the end profits. Now, that can help you better distinguish different explanations.
Returning question. So why do we do capital expenditures? That's because we want to get future earnings.
Yes, so that's great. again, the puzzle comes back to we trace these firms out 10 to 15 years. So if the explanation is you have current low earnings because you're doing massive CapEx, that's totally fine because that should translate to future earnings down the road. The puzzle essentially is we're tracing these firms out 10 to 15 years and we're still just not seeing those profits being realized. It's possible that it's something further down the road than even 15 years, but in a present discounted value, that starts to really take a large hit from all of the discounting. And we already see that the price is also falling largely to catch up to the earnings. So it's not that the investors keep the price high because they know these CapEx expenditures are going to translate to massive profits. But it is a fair point. The puzzle is just why aren't we seeing this CapEx turning into huge profits at year 5 or year 10?
Hi, I'm Sophia Tai with Trinity Church. Thank you for sharing your ideas. So I have two questions. One is, isn't momentum a product of the belief stubbornness? And also it explains the persistence of the discount rates. And the second question is that I'm a practitioner and picks fund managers to take advantage of these mispricings. So a lot of our fundamental managers are optimistic about these mispricings will narrow sooner than the market did. So if we do believe that exploiting this advantage arbitrage is a key source of alpha, how do I build in enough staying power to see the reversion before losing my job? Do you have any suggestions?
No, that's a great question. So one thing I want to be careful here is that we're almost arguing that there's not a lot of immediate alpha in this strategy because of these stubborn expectations. Now, if you're building a trading strategy, that's a very disappointing result. But one thing we want to emphasize is that if you care about the level of prices and say the efficiency of stock markets and capital allocation, that's actually quite important because it means my firm could be half the value of Ray's firm for no genuine reason of our underlying business, but just because of optimism. And yet this won't be corrected because I tell you it's going to take 10 years to correct. And so it's not worth it for basically people to start buying me, shorting him, and pushing us closer together.
Could I also add that that first empirical work that you did was forecasting out to 4 years using the subjective expectations of cash flow and discount rate for 4 years. And then there was also a component of expected PE 4 years down the road. So one also emphasis of the challenge of why you shouldn't, it's going to be hard to exploit was like 55% of the dispersion was still incorporated into future PEs 4 years out, right? So like it could get worse. You know, this Tesla thing could change. It could go 500 times. Like, and that's not, you know, that would still be part of consistent with your results.
Right. Yeah, it makes it risky to trade against. Now, to make it not entirely negative there, the point we're trying to raise, though, is if you have these long horizons, one, there's a question of why are you buying these firms? Kind of, if you sit down, what is the plan for this firm to return net present profits that justify the price that you're paying in? Because for some firms, it seems difficult to rationalize where this firm will earn enough profits to justify that price. And vice versa, there are other firms where it seems actually quite easy to rationalize the current value given its profits, and it looks like it might actually be quite undervalued. So part of this is highlighting that if you have the holding horizon, it looks like there is a substantial amount of mispricing. Again, 70% of the dispersion in price earnings ratios seems to be explained by returns. So if you have a 10 or longer year horizon, there's massive mispricing to be exploited. And then it's also trying to push the point that people should be very critical when they're buying into these firms, that a lot of these price ratios are very hard to justify. So it's hard to fight against once the price ratio gets to that level. But we also want to push the question of who was pushing the price ratio up to that point in the first place. And that people should be cautious so that they're not the ones basically bidding up these overly optimistic stocks or depressing these overly pessimistic stocks. But in terms of a trading strategy, our results would very much be tailored towards long horizon institutional investors. So essentially somebody that has the capital in the pockets to hold this out for at least 5 years.
We have time for just one final question.
Extremely interesting presentation. So thank you, first of all. Ray hinted at time varying risk premia. times when value might work better or less well. Have you considered anything around the sort of time varying in understanding the effect that you describe? It might be interesting to think about, how it varies through time. Have you done anything like robustness or variations in sub periods or anything through time?
So we have, but it's somewhat cheating in that this is a follow-on to a sister paper that we did earlier. In that paper, we basically separate out the analyst forecast. We just focus on what are the actual cash flows, what are the actual profits, going back to the 1950s. And there you can basically look at the 10-year moving averages of expected future earnings growth and expected future returns, where these are statistical expectations. And you do see these fluctuations over time, most prominently the 80s, the dot-com bubble, 2008. Surprisingly, while the importance of cash flows and returns fluctuates over time, there's never a point where the cash flows become more important than the returns. So it's not always 70-30. In fact, there are periods where it's almost 50-50. But what's surprising is it's not a case where in the 70s, high PE ratios did justify themselves with future earnings, but then in the 80s they weren't, or in the 90s they were. It's a fairly consistent fact that in the 70s, in the 80s, the 90s, etc., the future cash flows were just never big enough to justify more than 1/2 of the price earnings ratio dispersion. So there's certainly fluctuation, but there's still kind of this puzzle that we're just so far from 100% that there's this big gap that's left unexplained.
Thanks very much. Thanks to Ray and Sean for a great session.